What's going on, everybody? I am back a little bit later than I wanted to be. Some technical issues on the Microsoft Office side, but you don't need to hear my problems. So let's get into it. I wanted to do this video on how to read a prospectus for a mutual fund. I'm going to go over my outline as usual, really define a prospectus and what the purpose of one is. I'm going to use three different funds so we can compare and contrast. And then I'll go over my rules of mutual fund investing. I've gone over this before a little bit, but I'll tie it into actual data that you can see and very important information that the prospectus gives in order for you to make that investment decision, depending on whatever your investment objective is. So, looking at the definition of a prospectus in the non investment world, this is a printed document that advertises a commercial enterprise in order to attract clients or even investors as well. I've traced it back to about 1723 for a French meaning of a lookout, a view, and that's exactly what it does in the investment world under securities law. And in securities law, when a mutual fund is about to be sold, it's an essential disclosure document that a company has to issue at the time of issuing investment securities contracts to the public. It could be yourself, could be a husband and wife, it could be all sorts of different clients that I sit down with, and even if myself, if I'm looking at this from a long-term value investing standpoint, I would look at some of the detailed information in a prospectus, and I'll show you what I look for before I make my decision to throw money into it. So this has to be presented at the time of the sale or when a discussion of purchasing, at least between a licensed broker and a potential client, takes place. Usually they're emailed. They're not a physical document like they used to be, emailed in PDF form. So if you're sitting down with a licensed broker and they email you a bunch of stuff and then I don't have time to read all these documents, they're all PDFs. I get it. At least open up the email to say that you actually opened up the email to take a look. And I'll show you what to look for when a prospectus gets sent to you. This cannot have any markups, any edits, any highlights. This is a legal document. So if you got a broker and tries to circle something or highlight it with a pen or an electronic pen online, if it's a PDF, you're dealing with amateur hour here. So boot his ass out of your house if that is the case. Now, I'm going to look at three different funds, and there's a lot of different fund families that we could look at, but I want to compare and contrast three on the spectrum. One's an aggressive growth, which I've always defined as 11% rate of return or more. On the middle end, you're going to get something into maybe called an equity income fund or a growth and income fund. Usually you'll find, not always, but in the aggregate, you'll find 6 to 8% rate of return on those. And then I've already discussed the municipal bond fund and what they look like, but I'll show you what a prospectus looks like on a municipal bond fund so you can see how it compares and contrasts to the other three. Generally, 2 to 4% rate of return, nothing higher than that. Anything in the 6, 7, 8 range of a municipal bond, and they are out there. They're probably not the tax-free status that they have been reserved for many years. So again, my three rules for mutual fund investing. One, I'm always looking for at least a 25-year track record. And this is me. This is me when I sit down with clients to suggest something to them, or me when I'm personally investing. Some other people only need a 15-year track record or a 10-year track record. Whatever the case may be, these are guidelines. These are not rules that are set in stone that cannot be malleable or moved around. This is just myself when I'm doing this. And I always look at the investment objective of the fund to match my own or my client's personal investment thesis. My client is saving for college. There's a certain amount of fund families that they should be looking at. If they're saving for retirement, there's a certain group of fund families they should be looking at, or any other goals. Maybe they're saving for a down payment on a house. Maybe they're saving, and I'll get into videos like this where you can actually use mutual funds as a line item in your budget to pay yourself a car payment. So when the time comes around to make a car purchase, you can use liquidated cash that you have on hand and growth from these investments rather than going into debt and paying interest and much more money on a car than you normally would. And I always look for in the prospectus, there's going to be performance history, 1 year, 5 year, 10 years, and also since inception. But the big one is the 10-year, the past 10 years they'll go up to. you're usually going to see 2 to 3 positive return years for every 1 negative return year. You're gonna have negative return years. It's just the nature of investing. But I'll show you how to maximize that to kind of forecast for the next 10 years. Again, the past performance does not indicate future results, but when my mutual fund hits all 3 of these, I usually feel pretty comfortable recommending it and also invest it myself. I don't recommend things to clients that I myself don't invest in. So we're going to go over three different funds, and I want to make full disclosure. These prospectuses that we're looking at are not being offered to anybody who's watching this video. This is not a recommendation to buy, sell, liquidate, trade, or do anything of the sort. I'm only using these prospectuses as research, incidental to my career as an educator. This is not, hey, you really need to get into this, but I did pick 3 specific ones to compare and contrast. We'll go over each of them right now. Aggressive growth I've defined as 11% plus rate of return. And remember, I'm looking at aggressive growth. You're usually going to find them in small cap funds. So we're going to look at American Century's small cap value fund. The symbol is ACSCX since 1999. So we're at that 25-year mark, and it's average 11.15% rate of return since 1999. So pretty good track record there. For the equity and income fund, usually I rank that between 6 and 8% rate of return. We're going to look at Invesco's equity and income fund. Used to be Van Kampen's equity and income fund, but Invesco bought them out about 14 years ago. ACEIX. Since 1961, so over 60 years, it's actually outperformed what I would look at for my typical equity and income fund, 9.89% rate of return since 1961. So that's a 63-year track record. Not bad. And then for a municipal bond fund, the idea and the goal of it is to preserve income and not lose income, technically. So 2 to 4% is normally what you'd get. We'll look at Fidelity's intermediate muni bond, FLTMX. Since 1977, it's actually outperformed my normal range for municipal bond at 4.97 rate of return for 7 years. So not too bad. Not too bad at all. So let's go to my all right. So we'll look at American Century Investments. You can just Google literally that ticker symbol. You can Google American Century Investments, small cap value fund, prospectus. But the big thing is to get to their main page, because depending on the company, in this case, American Century, they'll have an overview, they'll have performance, risks and ratings, portfolio, the team who manages the funds. And then I always go to resources. Resources take you down to various little things. Interesting how they notice it, fund literature versus regulatory documents, right? Because, they have to put out an annual report. They have to put a semi-annual report out as well. The prospectus is there. The summary prospectus is there too. Don't go to that. That's just literally a summary. But the fact sheets, it's got pretty colors and graphs and charts, usually in some kind of slick that the licensed broker will hand the client. This is for small children and stupid people. Stay away from the fact sheets. I always say go straight to the prospectus, and we will take a look. Now, on the prospectus, we're going to look at first the investment objective. You have the table of contents, so you can find everything you need to. Most of this is their attorney saying hi. So if you want to go into the meat of it, I would go first to the investment objective. What do you want in an aggressive growth fund? SEEP's long-term capital growth. Income is a secondary objective. So this isn't something designed to preserve capital. This is pretty volatile on the upside. It's also volatile on the downside. So keep that in mind when you're thinking of your own investment thesis. If you want to invest in something aggressive, just be prepared to ride the roller coaster. Class A shares for retail are usually going to be the best performing ones. Why? Because that little 5.75% is what they call a sales charge or a load. It's on the front end when you purchase them, but when you sell the funds, there's no sales charge or load on the back end. So what you're basically looking at is if you put $100 into this fund, $5.75 of that $100 will go to the investment company, American Century, to the portfolio managers to manage that fund. Nobody works for free, as I've always said. and the other $94.25 gets invested into the shares of your investment, otherwise known as the net asset value. So I always look at that. I see if the investment objective, if I want to invest in something aggressive long term, boom, satisfies that. 5.75, that's industry standard. Sometimes you get lower on lower performing funds. The max is 8.5. They can't go above that. But usually the higher end ones, they have other companies to compete with. So they don't want to put their load charges in the 6-7% range, even though they legally can, because they've got other funds that are to compete with on different mutual fund companies. So then I'm going to scroll down to, here we go, the fund performance over the past 10 years. Remember what I said, 25-year track record, which they do since 1999. The investment objective, is it matching my long-term objective? This is something that I would invest in for retirement because I'm looking for a 10, 15, 20, 25, 30-year long-term rate of return for retirement. So suppose retirement is 30 years from now. That would fit into my objective thesis. And then what you're going to get is positive rates of return, 2 out of every 3 for every 1 down. So you see that 39.91 in 2013, 4.4, both positive, and then you had a negative year. Then you got 2 up years, 26 and 10% respectively. Then you had a down year, negative 17%. Then you had 3 up years, 33.51, 8.93, 36.91. Then you had a down year in 2022. Usually what you're going to find is just about every fund had a down year in 2022. What I found specifically with my clients, if you remember that during that time, that was when we started having peak month over month inflation, 8%, 9%, 10%. People were liquidating their funds just to put groceries on the table because they weren't prepared for the price increases. So every fund that you're going to see from 2022 is usually going to have some kind of negative rate of return. Very few that I've seen didn't. So now how would this work if I'm going to go and put this up here with my calculator? Hopefully you can see that, and this is actually coming up on the screen. Let's suppose you were going to invest $10,000 in 2013. 10,000. This is how it would work at the end of the year. You're going to multiply your $10,000, which is your principal cost basis, times your rate of return, which is 34.91%. So I'm going to multiply the 10,000 times 1, which is my original 10,000, 0.3491 to see what my rate of return would be. And at the end of 2013, let's say you wanted to cash out all of it, you'd have your original 10 grand that you put in, and then you'd have whatever rate of return the 34% gave you. In this case, 1.3491. Now you're talking after 1 year, you have now $13,491 in your brokerage account for just investing in an aggressive fund for 1 year. Now, the beauty of these investments is they're compounding on themselves. This is not simple interest. So that second year, that 4.4%, that's not on the original 10,000. That's on the 13,491 that you just grew it to. So what happens when you compound 4%, 4.4% times your original 13,000? 1.0440. Now you're up to 1408. So in 2 years, you've done pretty well for yourself, compounding. Now the third year, 2015, didn't quite get to any positive rate of return. That's like a negative, we'll just put negative 3% and round up. So you multiply that by 0.97 because you didn't quite hit your principal. So you lost money. So you went from 14,084 to 13,662. That's what happens in the investing world. Then the next 2 years, you look at a pretty positive rate of return times 1.2601. Boom. Now you're up to 17.2. The next year, 10.26 rate of return. Boom. Now you're up to 18.9. You've almost doubled your money in just 5 years, just because you're investing in something that's aggressive. These are the roller coasters that you're going to see. Big ups. And as you can see in 2018, a big down year will take your 18.9 and multiply it by 83%, 0.83, because you lost 17% on it. So now you're down to 15.7. But look at the next 3 years, 2019, 20, 21. Let's see what you end up with after those 3 monster years times 1.3351. Now you're up to 21,034. You've just doubled your money in 6 years. Let's keep going. 1.0893. Now you're up to 22.9. And then that 2021, you made 36.91, 1.3691. Now you're up to 31.3. So you just tripled your money in 8 years because you had the foresight to put something into an aggressive growth fund that fit into this investment criteria. It has a track record. You're seeing the 2 up years, 3 up years for every 1 down year. So you feel comfortable with riding the waves. This is a long term investment. This is not something you buy after breakfast and sell before dinner. This is something that you're going to either put the money in and hold long term, or to really get the interest of compounding going, you can actually put money into it on a monthly basis, which is what we recommend doing with, a Roth IRA, so you can have tax-free growth at the end when it's time ready to retire. Now, 2022, you lost 14%. So I'm just going to round it up to 15, times 0.85. All right. So in 10 years, you went from 10 grand to 26 grand. I think most people would take that kind of performance over the long term. Now you just got to do the same thing over the next 10 years, 20 years, whatever the case may be. Obviously, you're going to get more money out of this when you start putting money into it and not just putting the buy and hold where you put one clump in and just let it compound. You can do that. But I'm going to show you why, in other videos that to be active with this stuff is probably going to build your wealth in equities over the long term. Right. I'll get rid of that. And then, like I said, the rest of it's just the lawyers saying hi because they have to do it. But again, your goal with this in a prospectus, look at the investment objective, look at the sales charge, and then look at the last 10 years. If you see a lot of negative rates of return in the last 10 years, or if it's 5 and 5, or 6 negatives and 4 positives, again, I don't invest in those things. I don't recommend my clients do. But again, you're taking the risk on this on what your performing assets are going to do in the long term. So keep that in mind. Next, we'll go to Invesco. Invesco is a little bit different. So they'll have the same thing, all these little tabs, overview, performance portfolio. And instead of resources, this one says documents. So when you go to the documents, it'll list, again, fact sheets and all those things are glitzy. Remember, they're for little kids and stupid people. Go to the prospectus and the fund report. So with the prospectus for Invesco, this is an equity income fund. Go down to the investment objective. Fund's objective is current income and secondarily capital appreciation. So it's a little bit more reserved, conservative, not as aggressive. The roller coaster rides, as we're going to see, are not as steep as they are in that aggressive fund that we just looked at. So then you look at the sales charge, again, Class A shares. The last one was 5.75. This is 5.50. So again, for something that isn't going to give you 11%, this is a little bit lower. Over the long term, they're going to have lower sales fees. The other things to look at as well is annual operating fund expenses. That's probably something I didn't look at in the American Century, but look at it here. This is another thing that comes into play. If we're looking at 0.35 for management fees, 0.25. A lot of funds have what they call 12B1 distribution fees, which are mainly for marketing purposes. Other expenses that they may have, again, at the end of the day, it adds up to 0.78. So our last example, we had about $26,000 in there. And this is on an annual basis to manage that type of return, 0.0078. So that'll cost $200 per year, usually billed quarterly. So about $50 per quarter to get you the rate of return that you just saw on that. And if you did the same thing with this fund here, it would do the same thing. So keep that in mind. The annual operating, the fund operating expenses, the rate of return that they give you on these over a long period of time more than makes up for what the fund expenses are on a yearly basis. And More terminology and definitions. Here we go. Here are the past 10 years. Now, as you can see, we're not going up into the 30s and dropping into the 17% range or the 14 -14% range. The an equity and income fund where the investment objective is preserving capital and then growth secondary, you can see the swings are a little bit more reasonable. Again, 10 years ago, 24.96, then to 9.07, then in 2015, negative 2.35. Then we're up to 14, up to 10, down to 9.65. Then we got three positive years, 20%, 9%, 18%. Then we had a negative year, as we've always seen in 2022, negative 7.72%. So as you can see from this compared to this, the swings on an aggressive fund, as you can see, are much greater than an equity and income fund, which are a little more reasonable and managed. The joke around the office that we have with Invesco's equity and income fund, we call this grandma's mutual fund because this is the one that grandma invested in when she was raising her children with grandpa back in the 1960s and 70s. And it's the one that has a pretty, 60 something year track record of about 9 to 10% roughly. So not bad. Again, I'm not recommending it. I'm just showing you historically what this has looked like. If you were going to do this for the next 10 years, 20 years, 30 years, if the objective is the same and the performance has as and the track record has been there, you can pretty much count on this you're going to ride those waves because the markets are the markets. These guys are trading the same securities that everybody else is. And sometimes they're up and sometimes they're down. But if you get 2 to 3 up years for every one down year, you're in pretty good shape. All right, and then we'll go to Fidelity. This is their intermediate municipal income fund, their municipal bond fund. Again, fact sheet, small kids and stupid people, don't do that. Go to the prospectus, and then I'll see if this is sharing. Yes, it is. Okay, perfect. All right, and then again, objective Fidelity Intermediate Municipal Income Fund seeks as high a level of current income exempt from federal income tax as is consistent with the preservation of capital. So municipal bond funds, you're not going to grow them to the stratosphere. You're not going to have those swings like you saw in the last two. This is designed to preserve capital. So you run some of these crypto plays and ladder them up into crazy stuff. You might want to think about how you're going to preserve that because you don't want to lose that kind of money when you actually have it. The annual operating expenses, much less, about half of what an equity and income fund is at 0.36%. Looking at that. And then here's the rate of returns. You got 2 to 3 up years for every negative year. So you got 2 up. But look at the swings, 6%, 2%, negative 0.01%, which is pretty much breaking even. 4, 1%, 6%, 4%, 1%. Then you had a negative year in 2022, like everybody else did, negative 6.27. And now that we're entering data for 2023, back up again. So you're seeing in a municipal bond fund, the idea is to preserve capital. And they pretty much did that for every year except 2022, which was the norm in the markets at that time. So with that being said, current slide. So here, back just to wrap up, look at these three rules. If you want to adjust your rules for your own investment thesis, you have shorter term goals, that's fine. The 3 things that we looked at for the investment objective of the fund, if you were looking for retirement, an aggressive fund wouldn't be an unreasonable investment thesis, in my opinion. If you're looking to invest in college, something between an equity and income fund and maybe an aggressive fund, maybe a little bit in each, wouldn't be out of the ordinary, because if you have an 8-year-old right now and they're going to college at 18, you have 10 years to save. So you want something that's going to have some growth so you can sock some money away in an educational savings account, as an example, so you could have tax-free distributions for their college when they decide to go, if they decide to go. And then other goals, you may have shorter term goals. Like I said, I'm going to do a video on car funds that you could set up with this. If you want to buy a boat, if you want to just save for a vacation, if you want to save for a down payment on a house, there's lots of different ways to do this. I'll go into different videos that show you how to match that with your current budget. And then the third rule that I say is that when you see in the prospectus the past 10 years of performance, I always look for 2 to 3 positive return years for every one negative return year, and then you're at least investing in something where the fund objective is matching their actual performance of them moving these securities investments around. So, hope this was helpful. Hope this was valuable. Sorry about the delay. I'm still beating the hell out of Microsoft Office. If I could just pick it up and throw it against the wall, I would right now in its physical form. But I'm going to go do some hot yoga and forget about that. So I don't get into that angry stage. So, hope this was helpful. Giant hugs, everybody.